In this module, we'll connect customer due diligence to real AML and CFT work. You'll see how onboarding, verification, and ongoing reviews function in practice, how beneficial ownership is identified, and how strong CDD files protect your institution, your customers, and your own accountability. Customer due diligence is much more than collecting documents at onboarding. Think of it as a living, ongoing relationship with the customer. We start by identifying who they are and why they need our services, and then we keep reassessing that picture over time. As their behavior, products, or geographies change, our view of their risk must evolve with them. Effective CDD is a dynamic risk ecosystem, not a static tick box exercise. Now, imagine CDD as a dynamic engine rather than a one-time checklist. You begin by onboarding the customer, verifying identity, and forming an initial risk view. From there, you build a baseline profile: who they are, what they do, and what activity you should expect. As transactions and news flow in, monitoring acts like sensors. When something changes, new behavior, new owners, negative news, it triggers a review. All of this feeds back into the customer's risk rating, which then determines how often you review them and how closely you monitor future activity. To detect suspicious activity, you first need a behavioral baseline for each customer. CDD is not just who are you, it's also how do you normally use this account. We look at the stated purpose of the account, the size and type of activity we expect, who they typically transact with, and whether this matches their occupation or business model. Anything that sits outside that baseline warrants closer attention. The type of customer dictates how deep your due diligence must go. For individuals, the risk is often more straightforward. Confirm who they are, where they live, what they do, and watch for PEP status or negative media. Corporates add another layer. You must confirm the company really exists, then peel back the structure to find who ultimately owns and controls it. For financial institutions and other high-risk entities, the emphasis shifts to their regulatory status, control environment, and how robust their own AML frameworks really are. Ultimate beneficial ownership is about finding the real people behind a customer, not just the names on the documents. Regulators typically expect you to identify anyone who owns 25% or more of a company, though many institutions set even lower thresholds. But ownership is only half the picture. You also need to understand who actually controls decisions, for example, through voting power, nominee arrangements, or informal puppet master influence. When you analyze ownership, your real goal is to reach the ultimate beneficial owner, the person who truly controls the customer. Money launderers deliberately hide that person behind layers. They may stack offshore holding companies, use complex trusts, book entities in secrecy jurisdictions, or appoint nominee shareholders. As an AML professional, you're expected to challenge these structures and keep digging until the controlling individuals are clearly identified. Alongside ownership, you also need to understand where the money comes from. Source of funds is like a river, where the specific money for this particular transaction is coming from right now: salary, a property sale, or a loan drawdown. Source of wealth is like the reservoir, the customer's total accumulated assets built over time. Effective AML work depends on both the river and the reservoir making sense and being legitimate. Source of funds and source of wealth. Answer related but distinct questions. Source of funds asks, where did the money for this specific transaction come from, right now? You evidence it with payslips, a recent property sale, or current business invoices. It is especially important for single large or unusual movements of money. Source of wealth looks at the bigger picture. How did this customer build their overall fortune over time? Here you rely on tax returns, audited financials, inheritance records, or long-term investments, and you focus on this more deeply for high-risk and private banking customers. All of this comes together in how you keep the CDD engine running over time. First, continuous screening and monitoring watch transactions and names in real time. They compare behavior to what you expect and rescreen against sanctions, PEPs, and adverse media. Second, event-driven reviews act like instant alarms. A change in ownership, a sudden large transfer, or exposure to a new high-risk country should immediately trigger a fresh review. Finally, periodic reviews are your safety net, making sure every customer is revisited on a risk-based schedule. Risk-based due diligence is about matching your effort to the level of risk. At the base, simplified due diligence applies to clearly low-risk relationships, such as well-regulated banks in strong AML jurisdictions or very low-value products. Here, you streamline documentation and review them less often. Most customers fall under standard due diligence. You verify identity, beneficial ownership, and the purpose of the relationship, then review on a normal cycle. Enhanced due diligence is reserved for genuinely high-risk cases. You go deeper on source of funds and source of wealth, obtain senior approval, and monitor activity much more intensively. Customer due diligence is not just paperwork. It is how institutions protect their integrity. When you treat CDD as a living, risk-based ecosystem, you see customers, behaviors, and patterns more clearly. That clear lens lets you challenge inconsistencies early, justify your decisions, and protect both your organization and the wider financial system. In AML and CFT work, meaningful transparency remains your strongest defense.